Three main choices for long-term care insurance. In this episode, I'm going to address which types of long-term care insurance are best or is best. Get ready. I'm going to introduce one to you that you've probably not heard about before. So my name's Doug Andrew, and I've been helping people optimize their financial assets now for more than 47 years. And in doing that, most people have come to me wanting to save the best way for their golden years, their retirement. And I actually show them that traditional accounts like IRAs and 401ks may be a good way to go, but they're a far cry from the best way to go. Roth IRAs and 401ks may be a better way to go, but I've never owned an IRA or 401k, never will. I've never owned a Roth IRA or 401k, never will. So then they want to know, well, where do I recommend people put money, or that they put their money? And I show them where I would recommend 40 to 60% of your retirement income not even show up on your 1040 tax return when you go to use it. And they go, well, how does that work? It's basically a max funded tax advantaged insurance contract where you're taking the least amount of life insurance benefit you can get away with under IRS guidelines based upon your age and gender, and you're putting in the most money, the most premium the IRS allows as fast as they allow, and you're doing it primarily for living benefits. So in other episodes on this channel, you'll see that people can sock away $10,000 a year, $100,000 a year, $1 million a year. It accumulates tax-free under Section 72E of the Internal Revenue Code. And when they go to access the money, and you don't have to wait till you're 59 and a half, we have people retiring in their 30s and 40s, they access the money tax-free. And you can learn that every $1 million that you accumulate can generate $80, $90, $100,000 a year of tax-free income for as long as you live if you structure it correctly, okay? And then when you ultimately pass away, it blossoms in value. If I died right now, every $1 million in my laser funds would blossom to about $2.5 million and transfer tax-free to my wife, my kids, my grandkids if I died. Well, if you maximum fund that, you can self-insure, and that's what I've told most of my clients. Hey, you don't need to buy long-term care insurance unless you're really worried about it and you want to have an extra insurance policy for that. But if you don't ever need the benefits, the money's down the drain. You actually have access to your money over into a max funded insurance contract. Well, there's a new option that I have become aware of that has been introduced lately by companies such as Pacific Life. So I want to show you the three types that you can choose from and why you may want to consider what is called an asset-based long-term care insurance strategy. Here we go. So here on the screen are some illustrations, compliments of Pacific Life. And the common long-term care insurance types today are traditional long-term care insurance. And again, this is designed to pay for some of those expenses if you have to go into a facility for a long time and there's certain qualifications. You can't perform at least 2 out of 6 basic functions that humans usually can do. And so you have to qualify for the long-term care. The problem is if you use traditional long-term care insurance, you have to use professional services. You cannot stay at home and have family members or friends take care of you. You have to use the professional people to do that. Most of these plans are based upon what is called reimbursement. So they reimburse you for those expenses if they qualify. Sometimes you have indemnity. And that's where an insurance company will indemnify. They'll pay you. It may be a reduced amount, but you can use your friends and family to take care of yourself. But a lot of long-term care insurance does not allow that, whereas these do, because you have those choices. Now let's go over to number 3. That's the life insurance that I talked about earlier. For many of my clients, they may have started out socking away, $500 a month, and they did it for 30 years, and they now have $1 million of tax-free cash accumulation in their life insurance contract. That $1 million can generate $80,000 to $100,000 a year of tax-free income. But if they had a catastrophic illness and a long-term care need, they could go dip into $100,000, $200,000, $300,000, $400,000 of that cash tax-free inside that insurance policy. But if they do, then it's going to reduce that down, and it could affect the death benefit. But they're self-insuring. They have the money, and it saves the premiums they have to pay for the rest of their life under a traditional long-term care policy. So this is life insurance, or some life insurance policies have an accelerated death benefit, meaning if you had a $1 million death benefit and you have a long-term care need, and you prove that to the insurance company, they can give you access maybe up to half of your death benefit. In this case, if you have $1 million, you can access up to $500,000 of that death benefit without dying. And you use it to pay for those expenses. But then the remaining death benefit has been reduced down. But that way you can utilize the death benefit or the cash values using strategy number 3. Well, what's strategy number 2? It's what is called an asset-based long-term care insurance. And this is where I have found that many people have money that they have earmarked for those kinds of expenses, and it's sitting in some bank or credit union, and it's earning a pathetic rate of return, usually less than 1%. They have $100,000 or $200,000 sitting there, and I say, what's that for? And they go, well, it's like a rainy day fund. It's in case I need it for long-term care. And I go, well, yeah, so when you look at this situation, you're not having to pay these premiums forever, even though the long-term care insurance is there to pay for those costs and what have you. You at least don't have to sit there and pay premiums the rest of your life, and there you're self-insuring. So depending on whether you use it or not, this could be a better way than the traditional approach. If you're using the accelerated death benefit rider, like I say, then sometimes you're lowering down the death benefit. Well, when you use an asset-based one, you are repositioning money. You're taking money from the bank or credit union, let's say, and it's over here earning a measly 1%, let's say $100,000 or $200,000, and you're moving it from your left-hand pocket, so to speak, to the right-hand pocket. It stays on your balance sheet. It is an asset. You can grab the money anytime you want. You're just moving it out of the bank or credit union over to an insurance company that frankly is usually rated 5 or 6 notches higher in safety than the banks are, okay? This is how it works. You move the money over to the insurance company, and you just did it in a lump sum. You can access that money. If you need to, you can cancel and just withdraw. If you die, you still leave behind the $100,000 like you would in the bank. So what's the advantage? Well, what if you need to have access to that money for expenses? If it's sitting in a bank or credit union, you can only access what's in there, $100,000. Once that's gone, it's gone. With asset-based long-term care, you're able to immediately have up to $200,000, $300,000, $400,000 of benefits, and the older you get, it can go up to $600,000 or $700,000 of benefits by having that asset-based long-term care. And if you never use it, you get a 100% refund of the $100,000. If you die, you still leave behind $100,000. Whereas traditional long-term care, it's gone. Out of the 3, this is one that I think many people ought to strongly consider who are already self-insuring. They already have money in a bank or credit union earmarked for those long-term care needs in sort of a rainy day fund. Just move it from this pocket over to this pocket. It still shows up as an asset on your balance sheet. You can still grab the money when you need it. If you die, it still is transferred to your heirs. But if you happen to need long-term care, it will pay out as much as $300,000, $400,000, $500,000, $600,000 for the $100,000. If you left it in a bank or credit union, it's gone after you've gobbled up that $100,000. Does that make sense? Sometimes people say, well, that sounds too good to be true. If you want to learn more, join us for an educational webinar. What I would like to do is gift you a copy of my most recent best-selling 300-page book called The Laser Fund. Now, the Laser Fund is actually what I have helped many clients accumulate a lot of money in tax-free to self-insure. But some savvy people will reposition money out of a bank or credit union. They may even leverage money out of the insurance policy and put over here so that if they have a long-term care need, they will be able to leverage and end up with 3, 4, 5 times the amount in benefits, but still keep that as an asset on their balance sheet. So this is what I want you to do. I want you to go to laserfund.com and claim your free copy of my book. You'll then be entered into our database, and I'll notify you every time we teach an educational webinar. We do one on long-term care about once a month, and I don't want you to miss out. They usually last about 30 to 45 minutes. We follow it up with about 15 minutes of live Q&A, and you will be able to learn which of these 3 options may be best for you so that you can utilize and optimize your assets and, of course, minimize tax. And this is why I would recommend many people consider this one, because they've never heard of it before. This one would be the next choice, or maybe even first choice for many of you. But frankly, I have never, ever helped a client get this one. Sometimes I've pointed them to an advisor who sold this, but I've never wanted one for myself. And I do not like recommending things to people that I would not put my own money into. That's just my personal opinion. And in my particular situation, I have never worried about having to have this money paid out of an insurance policy and then have nothing for it if I don't need it, because I try to take care of myself. But in case something happens, I have money over here. Or now, with this strategy, that will be far better, in my opinion, than most of these types of policies. So go to laserfund.com, LASER fund.com, and contribute a nominal amount towards the shipping and handling, and I'll cover the rest of that cost. And I'll fire out a copy of this 300-page book to you called The Laser Fund, How to Diversify and Create the Foundation for a Tax-Free Retirement. And this vehicle, you'll see, satisfies this third choice for many, many people. But if you want to leverage and be able to have access to maybe 2, 3, 4, 500,000 of benefits by simply repositioning assets that are underperforming or non-performing in a bank or credit union, you'll be entered into our database and notified when we teach an educational webinar, which we do several on all kinds of topics. But go to laserfund.com. I'll fire out a copy for you, and here is to your brighter future.